The legendary investor Peter Lynch was one of the greatest ever when it came to beating the stock market. His approach to investing was based on fundamental research, patience, and a keen eye for growth opportunities. That's why in this video, we will show you how Peter Lynch consistently beat the market for decades and some of his most important lessons when investing in the stock market. Lynch's extraordinary performance as the manager of the Magellan Fund was one of the most notable elements of his career. The fund outperformed the S&P 500 index during the periods from 1977 to 1990, with an average annual return of about 29%. For the same period, the S&P 500 had an average annual return of 14.5%. Not too bad if you ask me. Now, let's look at some of his most important principles. Principle number 1. Invest in what you know. Peter Lynch has written several books on the topic of investing, with One Up on Wall Street being the most well-known. In this book, Lynch discusses the importance of investing in what you know. Investing in what you know was a key component of his investment philosophy, and he often emphasized how going to the shopping mall played a crucial role in identifying potential investment opportunities. Lynch believed that individual investors had a distinct advantage over institutional investors because they could observe consumer behavior and trends firsthand. Lynch was aware that profitable investments frequently involved businesses that offered goods or services that people valued and were prepared to pay for. He learned about customer behavior and new trends by visiting different malls and seeing which stores were crowded, what goods were popular, and what services were in demand. He also paid close attention to brand popularity and customer loyalty. He believed that companies with strong and recognizable brands such as Home Depot and Walmart had a competitive edge over their peers. A visit to the mall also allowed him to see which brands were resonating with consumers and which companies were effectively marketing their products or services. While at the mall, Lynch could also observe how companies differentiated themselves from their competitors. He looked for companies with unique offerings, innovative products, or efficient business models that gave them a sustainable competitive advantage. Principle number 2. Growth at a reasonable price. GARP. Lynch's method of investing may be characterized as a combination of growth and value investing. He looked for businesses with significant room for earnings growth that weren't overpriced in comparison to their prospects for the future. In an effort to get the best of both worlds, he searched for businesses with fair valuations in relation to their rates of earnings growth. He believed that in order to achieve above-average returns, it was essential to invest in businesses with significant room for growth. He searched for businesses that had the potential to considerably increase their revenues and earnings over time. These businesses frequently produced cutting-edge goods, increased their market share, or engaged in long-term growth trends in their respective industries. GARP investors like Lynch focused on companies that were consistently increasing their earnings. A company's ability to grow its profits over time was a fundamental indicator of its underlying strength and potential for future growth. Lynch sought out businesses with potential for growth, but he was also conscious of the cost. Even if equities had significant growth potential, he avoided spending too much for them. Lynch and other GARP investors were wary of going after speculative, high-flying stocks that frequently saw extreme price swings. Instead, they concentrated on businesses with strong fundamentals and foreseeable future growth. And by the way, if you've made it this far into the video, hopefully you're finding it helpful. Make sure to subscribe and leave a like on the video so you don't miss any of my future videos related to investing and finance. Principle number 3. Long-term perspective. Lynch was a big advocate of long-term investing. He held on to winning stocks for years, allowing them to realize their full growth potential. He believed that patient investors who stayed the course and avoided frequent trading could benefit from compounding returns over time. Lynch's long-term strategy revolved around investing in high-quality companies with strong fundamentals. He looked for businesses that had a competitive advantage, consistent profitability, and a proven track record of success. Lynch was not a market timer. He emphasized the importance of staying invested through market ups and downs. He believed that attempting to time the market was challenging and often resulted in missed opportunities. His mantra was to buy right and hold tight. When he identified a winning stock, he was willing to stay invested in it for years or even decades, and understood that the most significant gains often came from long-term ownership of successful companies. Lynch had a reputation for ignoring the short-term market turbulence and concentrating on the long-term prospects of the companies in his portfolio. He did not allow weekly or daily changes to influence his investing choices. The power of compounding returns was a crucial aspect of his long-term approach. By reinvesting dividends and allowing investments to grow over time, he took advantage of the compounding effect, which can significantly enhance wealth over the long run. Principle number 4, portfolio diversification. While Lynch had his favorite stocks, he emphasized the importance of diversification. He recommended spreading investments across various industries to reduce risk and capture opportunities in different sectors. Lynch believed in maintaining a balanced level of diversification in a portfolio. He recognized that holding a variety of stocks from different industries and sectors could help reduce risk. Diversification allowed investors to benefit from potential winners while minimizing the impact of any individual stock's poor performance. Lynch was not a supporter of holding an excessive number of stocks only for the sake of diversity. While running a sizable mutual fund, he committed to the philosophy of concentrating on his best investment ideas and taking substantial positions in businesses he had carefully investigated and believed in. But at the same time, Lynch generally held 1,000 to 1,400 individual stocks at any given time while managing the Magellan Fund. Although this may seem like a lot, it's crucial to remember that the fund's assets under management were sizable and peaked at over $14 billion, and that he put most of the money into his very best stock ideas. As a result, the large number of holdings enabled diversification across a variety of businesses and industries. His investment strategy involved investing in various types of companies, including large cap, mid cap, and small cap stocks. The belief is that smaller companies often offer greater growth potential, while larger, well-established companies provide stability and dividend income. Principle number 5, fundamental analysis. Peter Lynch was a master at performing fundamental analysis, a method of evaluating a company's intrinsic value based on its financial and operational data. He used a combination of quantitative metrics and qualitative factors to assess the health and potential of the companies he was interested in. Lynch carefully went over a company's financial statements, including the balance sheet, income statement, and cash flow statement. With the use of these documents, he was able to evaluate the company's financial situation and profitability by learning about its assets, liabilities, revenues, expenses, and cash flow. One of Lynch's key criteria was consistent earnings growth. He sought out businesses that had a history of growing their profits over time, a sign of a thriving and well-managed company. A company's stock price is compared to its earnings per share using the price-to-earnings ratio. Lynch analyzed a stock's valuation in relation to its rate of profit growth, using this measure to determine whether it was fair or overvalued. In particular, he looked for businesses with fair price-to-earnings ratios in relation to predicted profit growth. Lynch was also a firm believer in the value of field research. He visited the company's stores, spoke with customers and employees, and used its goods or services personally. He was able to get important insights thanks to his practical approach that weren't necessarily apparent from financial numbers alone. Make sure to subscribe and watch the other videos on the channel for more investing and finance-related content. See you soon.